This is going to be another episode of my series Time in the Markets. And today I wanted to discuss adaptability in the market and nimbleness, being able to switch and adapt to what the market does. There are two major things I want to talk about. The first one has to do with, let me take this off. The first one has to do with this bit of price action that is going on over here and why. So this is live in the market, and why I believe that this high that was just formed, although it was engulfed by this massive 15-minute bearish candle, although this happened, there is no trade to the downside just yet, and why I believe that this high is eventually going to get swept, going to get taken before the real bearish move occurs. And I also want to talk about this entire trade setup, what I'm looking at. So let's start on the 4 hour. That's my higher time frame. Now we can see that on Euro USD, price traded into this monthly low and started trading bullishly, albeit not with a lot of momentum. So this is this week's price action, which I will analyze in my weekly review video. But we can see that on Wednesday, this fair value gap was created. Now, if we go up to the weekly time frame, we can see that there's a weekly fair value gap sitting right here, and price is trading out of a monthly fair value gap and is heading towards the weekly fair value gap. That is our draw on liquidity. And you might recall that in my video, I said that I was waiting for price to trade into this weekly fair value gap, and then that I was not going to do anything inside this range because I wanted to see if it was going to get traded through or if it was going to push price back down. That would have been the case if price had traded into it, let's say, within the first 2 or 3 days of the week. But now the entire week's range has essentially just about played out. This week has rallied about 253 pips, and today is Friday. So if price trades into this weekly fair value gap, I might look to take what is known in the ICT circles as a TGIF setup. The TGIF essentially is that if the entire week has traded in one direction, there is a chance that Friday might offer a small retracement back into the range to create the wick of the candle for that week. So it's essentially a short term trade in the opposite direction of what the market did during the first 4 days of the week. But before we go into that, this is why I have now shifted my bias to short term bearish, and I am anticipating taking a trade today, either during London or during New York session. Let's go down to the daily from the weekly. On the daily, we can see that we have these equal lows here. This candle's high, this candle's high. They form the base of this weekly fair value gap that we see. We also have a daily swing point here that has just been taken by that 15-minute bullish candle that I think is going to get taken, that I showed you on the 15 minutes. So this is the daily swing point. Price has now traded through it. It has given a bit of a bearish reaction, but I do not trust that bearish reaction just yet. And this is why. The reason is that on top of this daily swing point, we have a weekly PD array in the form of a weekly fair value gap. And I would only trust a move lower, a bearish reaction out of this zone, if price trades into this weekly fair value gap, taking out these daily highs. And we'll see the relatively equal highs more clearly on the lower time frames. Now, this is what I was looking at on the 4 hour. This was the trade I initially had in mind. When price showed all this bullishness, created this huge 4 hourly fair value gap here, respected it, traded out of it, consolidated a bit in this area, then broke out, creating this fair value gap. This became my new trading range from this low to this high. This 4 hourly fair value gap we can see is situated in the discount of the range, and as at yesterday London session, price was already trading lower, heading towards that level, and I thought I might have a trade yesterday morning or afternoon. Then this is what price did on the 15 minutes. So this is that price action from yesterday. Price was trading lower. You see that Asia range consolidated here. London traded lower, gave this double bottom formation that looks like a W, relatively equal lows. We like to see that. Yesterday was also Thanksgiving, so New York session really didn't do much since it was a bank holiday. But you can see that it also traded lower, stopped just about where the double bottom had stopped, and then traded higher. This gave me more confirmation in my desire to take the long trade, because when you have, remember, my trading strategy revolves around having a higher time frame fair value gap, that's the 4 hourly. Then on the lower time frame, I want to see time based liquidity points form. So if I want to take a long trade, I want to see London low, New York low, yesterday's low. I want to see them taken out. So this is what I was anticipating price to do today after yesterday's price action. I wanted to see price do something like this: take out all these lows, trade into the 4 hour fair value gap. Then I was going to look to take a trade long outside of the 4 hour fair value gap into the weekly targets that we have outlined over here. So the weekly target is what we can see sitting just above price. But what happened was that price did not do that, right? During Asia session, price, sorry for that. During Asia session, see, price just consolidated, still with an upward tilt. And then coming into London session this morning, price has continued to trading higher. Now, this was the range that I was looking to trade from this low, from yesterday's Asia low to this high, right? You can see how the 4 hourly fair value gap sat nicely around the 75% retracement level. So this was the range. I wanted price to come into this level. Then I take a long trade out of it, targeting this high, yesterday's high. But now, without giving me that entry, yesterday's high has already been violated during today's London kill zone. Now, London session has not yet opened. It's opening in about 3 minutes, but we are in the kill zone and it has been taken out already. Normally, this would form the basis for a short trade for me, because again, I like to see. So this is a daily high. This is yesterday's high. So it's a daily resistance point. I want to see price trade through it, take it out. And then on the lower time frame, the 15-minute time frame, I want to see a huge engulfing candle. So ordinarily, this would have been a setup that I would take short. I would place a sell order here. My stop goes above the high. And then I would target these relatively equal lows. That gives me 1 is to 2, 1 is to 2.6, thereabout. Or I outrightly target this 4 hour fair value gap. So this would have been a trade that I would have taken. The reason I'm not taking it is because when you look, let me go to the 1 hours. Because when you look left, not so far away from this high over here, get this out of the way, we can see that although this high has been taken, it's a lower time frame high that isn't as important compared to this weekly level. So you see, we have relatively equal highs sitting beautifully over here. This high right here, right? And then this high as well, right? So these are relatively equal highs, right? You can see them sitting above price. And there's a weekly fair value gap right here. So I would prefer to see price draw up into this purple shaded area before I can trust whatever bearish price action I see on the lower time frames. Now, I may very well be wrong, and this rejection that we are beginning to see, this reaction, may very well be what would push price lower, and I'll end up missing the trade. But this is why being adaptable, being nimble, and having experience in the market is important, because there have been many times where I will take this trade as it is right now, and price may give a bit of a reaction, maybe give me 0.5 R in profits, but ultimately just reverse, take me out, go into the weekly level before trading lower. So I don't want to risk my money on something that is lower probability. There is a higher chance of price taking this high out and going for the liquidity that is sitting above it on the higher time frame than pushing price all the way down from here. That's not to say it cannot happen, but in my experience and my knowledge of the market, there's just a higher chance of it happening. Now, let's say I do not get an entry and price just trades all the way down. If price is able to cover this, how many pips is it from this entry? If price is able to if price is able to cover this 72 pip range today, between London and New York session. And at the start of New York, during New York kill zone, for example, I see price trade below these lows. So it eventually does what I want, takes these lows out, trades into the 4-hourly fair value gap. I would still look to take a long. Why? Because the ultimate target, the ultimate objective, which is this weekly fair value gap, has not yet been traded to. So if I see that sort of thing, I will look to take a trade long out of here into the weekly fair value gap. So that's what I wanted to talk about essentially. Adaptability in the market in terms of switching my bias. I wanted to see price trade lower this morning and take out these lows and then give me a long trade going up. But it has already started going up without me. And so now, if price is heading to what my target would have been in a long trade, then what it means is I can switch my bias. One, since this is Friday, price has already traded heavily bullishly throughout the week. I can expect a small retracement back into the range. So since it's Friday, that's one. And then two, since price is closer to the objective than it is to my entry. So by the time price goes to your objective without coming towards your entry, the objective can now become your entry, and then your would have been entry now becomes your objective. So there's every possibility of me taking a trade that would look like this morning. Price trades, let me price trades into this level today during London session, or maybe during New York, and then gives me an entry short. So this is what my trade might look like today. None of this has happened yet. I do not know if price will go up. I do not know if price will go down, but I do nothing for now. That is adaptability in the markets. That is planning. So now you know what my action plan is. I know what it is, and I'm just waiting to see. If price trades lower between now and New York open, I take a long trade because this is my objective. But if price goes to the weekly level before coming down, then I anticipate a short-term bearish reaction from that level. That's what I'll be looking at. I'll see how it plays out.